Welcome to Investor Think. Today we're going to be diving deep into the mindsets behind different investing strategies. As we all know, the stock market can be a highly unpredictable and volatile world. But the one thing that sets successful investors apart from the rest is their mindset. They all have a certain way of thinking and approaching their investments that ultimately leads to their success. In this video, we're going to be exploring the different mindsets behind popular investing strategies such as value investing, growth investing, and momentum investing. We'll also be discussing how to develop the right mindset for your own investment strategy and how to avoid common pitfalls that can lead to poor investment decisions. So whether you're just starting out or are a seasoned investor, this video is for you. Stay tuned as we take a closer look at the mindsets behind investing strategies on Investor Think. Remember that the contents of the video is for educational and informative purposes, and always conduct the research and consult with professional before making any financial decisions. Investing can take many forms, and there are countless strategies that individuals can use to try and achieve their financial goals. However, behind each investment strategy is a particular mindset that guides the decision-making process of the investor. In this script, we will explore some of the most common mindsets behind investing strategies to gain a deeper understanding of the choices and actions of investors. One mindset behind investing strategies is that of the value investor. Value investors believe that the market is inefficient and that there are opportunities to find undervalued assets that will eventually be recognized by the market. They are willing to take a long-term approach to invest and have a keen understanding of financial statements and the underlying fundamentals of a company. Value investors look for stocks that are trading at a discount to their intrinsic value and are patient in holding onto these assets until they reach their full potential. Warren Buffett is perhaps the most famous example of a value investor. Another mindset behind investing strategies is that of the growth investor. Growth investors are more focused on the potential for a company to grow in the future, rather than its current financials. They are willing to pay a premium for companies that they believe have the potential to grow at a rapid pace. Growth investors are typically more focused on technology and other industries that are expected to experience significant growth in the near future. They are willing to take on more risks in the hopes of reaping greater rewards. Peter Thiel is an example of a growth investor. A third mindset behind investing strategies is that of the income investor. Income investors are focused on generating a steady stream of income from their investments. They are typically more conservative in their approach and tend to focus on investments that provide a steady return, such as bonds, dividend-paying stocks, and real estate. Income investors are more focused on preserving capital and are less interested in taking on significant amounts of risk. Benjamin Graham, a mentor to Warren Buffett, is an example of an income investor. A fourth mindset behind investing strategies is that of the momentum investor. Momentum investors believe that the market is often driven by short-term trends, and they try to capitalize on these trends by buying assets that have recently performed well and selling assets that have performed poorly. They rely heavily on technical analysis, using charts and other market data to identify patterns and make trading decisions. They are willing to take on a high level of risk in pursuit of quick profits and tend to be more focused on short-term gains. George Soros is an example of a momentum investor. A fifth mindset is that of the contrarian investor. Contrarian investors believe that the market is often driven by emotions and that investors tend to overreact to news and events. They attempt to profit by going against the crowd and buying assets that are out of favor or selling assets that are in favor. Contrarian investors tend to have a long-term perspective and are willing to hold on to investments even when they are underperforming. They also have a high level of risk tolerance and tend to have strong convictions in their investment decisions. Howard Marks is an example of a contrarian investor. It's worth noting that most investors will not fit neatly into one category and often use a combination of different mindsets and strategies to make their investment decisions. In addition, it's important to point out that not all the above-mentioned strategies or mindsets guarantee success, and even successful investors, such as the ones mentioned before, can have losing periods. Investing is inherently risky, and it's always important for investors to thoroughly research and understand the risks involved before making any investment decisions. A sixth mindset behind investing strategies is that of the index investor. Index investors believe that it is difficult to consistently beat the market and instead focus on simply tracking the market's performance. They tend to invest in index funds or exchange-traded funds that track a particular market index, such as the S&P 500. Index investors are typically more passive in their approach and have a long-term perspective, believing that the market will eventually reflect the underlying value of the companies that it comprises. Jack Bogle, the founder of Vanguard, is an example of an index investor. A seventh mindset is that of the active investor. Active investors believe that they can generate higher returns than passive index investors by actively selecting individual stocks or other assets that they believe are undervalued. They tend to have a more hands-on approach to investing and spend a significant amount of time researching individual companies and sectors. Active investors may use a variety of investment styles, such as value, growth, or momentum, and are willing to take on a high level of risk in pursuit of higher returns. Daniel Loeb, the founder of Third Point Management, is an example of an active investor. An eighth mindset is that of the ESG investor. ESG, environmental, social, and governance investors focus on factors that go beyond the financial performance of a company and include factors such as the company's impact on the environment, its treatment of employees and stakeholders, and its overall governance practices. These investors believe that companies that perform well in these areas will be better positioned for long-term success and will be less risky investments. They tend to focus on companies that are leaders in their industries in terms of ESG performance and are willing to pay a premium for these companies. Larry Fink, the founder of BlackRock, is an example of an ESG investor. A ninth mindset is that of the quantitative investor. Quantitative investors use mathematical and statistical models to make investment decisions. They rely heavily on data and computer algorithms to identify patterns in the market and make trades. Quantitative investors tend to be more focused on short-term gains and are willing to take on a high level of risk. They are often used by hedge funds and other institutional investors. James Simons, the founder of Renaissance Technologies, is an example of a quantitative investor. A 10th mindset is that of the crypto investor. Crypto investors focus on digital assets such as Bitcoin, Ethereum, and other cryptocurrencies. They believe that the technology behind these assets has the potential to revolutionize finance and other industries. They tend to be more speculative in nature and are willing to take on a high level of risk in pursuit of potentially large returns. They may also have a long-term perspective, believing that the technology will eventually become mainstream. Roger Ver, one of the early Bitcoin investors, is an example of a crypto investor. The above-mentioned mindsets are not mutually exclusive, and some investors may use a combination of different mindsets when making investment decisions. It is also important to note that no investment strategy is foolproof, and even the most experienced investors can experience losses. Investing always carries risk, and it's essential to do thorough research and understand the risks before making any investment decisions. In addition, it is worth noting that a good investor should also pay attention to their own biases and try to avoid overconfidence, and be willing to adapt and change their approach if their investments are not working as planned. The most successful investors are those who can remain objective and disciplined, avoiding both the euphoria of a bull market and the despair of a bear market. In conclusion, each investor has a unique mindset that guides their investment decisions. Understanding these mindsets can provide insight into the choices and actions of investors, and ultimately help individuals make better investment decisions. Understanding the different mindsets behind investing strategies can provide insight into the decision-making process of investors and can help individuals make more informed investment decisions. Guys, please like, share, and subscribe to your YouTube channel, and comment below about this video so that we know what type of content you like. Thank you.